Hey guys, so today I'd like us to talk about IPO, which stands for Initial Public Offering. Okay, and what is an IPO? Well, let's say a company ABC wants to, go public and wants to issue some stocks for the first time ever. Well, that's called an IPO, okay? And which is the birthplace of public stocks. And typically when a company IPO, we say that it's going public. It means that they are issuing stocks and now the public can actually be trading those stocks in the stock market. And it's also a good way for businesses, okay? Because now they have public shares that are issued into the stock market. It's a good way for them to raise capital from public investors. And an IPO consists in two phases. First, there is the pre-marketing phase, okay, of the offering, and then there's the offering itself, so the IPO itself. And when a company is interested to IPO, it will usually, rely on some underwriters, okay? And the underwriters will lead the IPO process. And these underwriters, they will be part of the full process, okay? From due diligence, document preparation, filing, marketing, and the issuance of the IPO itself. And during this pre-marketing step, okay, typically the underwriter and the executives, they will decide. First of all, they estimate the demand and establish a final offering price. Then they'll have to select which exchange they want the IPO to be into, the New York Stock Exchange or maybe the Toronto Stock Exchange. You need to choose where you want your stocks to be traded, like which exchange you want your stocks to be traded in. The primary advantage for a business to IPO is to raise capital for the business, but it can also have some other benefits. For example, so the first benefit, as we just said, is that the company now get access to the entire investing public to raise capital. Also, when it comes to acquisition, it makes potential acquisition deals easier through share conversions. But also, it's easier to establish the value of the acquisition because now it's traded, you know how much each share is worth. So it's easier to evaluate, the value of the business. Another benefit in these guys that we'll touch base later, but basically now there's much more transparency on the financial of that business because every quarter they need to release, the financials of that business. And so for publicly traded companies, it's usually easier for them to borrow and have better borrowing terms if they need to borrow any capital compared to private companies. Just because the financial are out there, so any financial institution that want to lend them some money, they have the data compared to a private company where it's not as easily available. Another benefit is then the company can actually raise another round of investment just through a secondary offering because it already has access to the public market through the IPO. So now it can do a second wave, second offering basically. Another benefit is that public companies can attract and retain better management and skilled employees through liquid stock equity participation. So there's the ESOPs, employee stock ownership plan, that usually businesses put in place. But once the company is public, it's easier for the employees to sell those stocks and actually see the value of owning those stocks. So that's a good way to attract more talent. Another benefit of that is the company's exposure is going to be increased, because now the news is going to talk about it. Now it's not all good, there's disadvantages to an IPO and also some alternatives. Some major disadvantages include the following, so we'll go over a few points here. First of all, an IPO is expensive and the cost of maintaining a public company are ongoing. Like there's ongoing costs in order to be a publicly traded company. Like it's just overall more expensive than being private. There's also extra costs because now, as we mentioned, every quarter you need to do reporting on the financial and the progress of the business, and that increases the time and effort required of the management to create all those reports. Also, you can't be as secretive, okay? A publicly traded company is required to disclose financials, accounting, taxes, and other business information, which when you disclose all that information, that could potentially reveal some secrets that you don't want to go out there, but now you have to. Another potential risk is that the required funding might not get raised if the market doesn't accept the IPO and the IPO price. And a good example here is WeWork, for example. And I mean, WeWork is kind of a joke, and it could be its own video, and I might actually do one day a video about it just to explain to you out there like what happened with that business. But yeah, that's a typical example of a failed IPO where they went out saying our valuation is 47 billion. Here is the price per share, and the people and experts were like, whoa, wait a minute. We don't think you are at all valued to that amount, and then it just flopped. So in the end, it harmed the business more than it helped it, for sure. Another potential risk is that as long as you are private, you kind of choose who you want your investors to be. But once you go public, you don't really have any control on that, and so you could lose, control of that business quite quickly to potentially the wrong people. If someone come in and buy a huge amount of shares, and now they start to have a seat, a seat in the board of directors, for example, and maybe they start to make the decision, that could potentially harm the business because you don't have control on who is buying your shares. There's also a risk that the fluctuation in the company's share price can be distracting for the management, because it might be a switch from compensating based on from the real financials result of the business. It might switch to actually the stock performance instead. And so that can be disrupting for the management, which might put and look at the stock valuation more than they should and be distracted compared to the actual financial result of the business, which the business, that's actually what they should focus on. That's what's actually important for them. A risk where sometimes businesses put in place strategies to inflate the value of the stock, such as using, for example, excessive debt to buy back some of their stocks. The business is going to take on debt to buy back shares from its own business, and that typically what's going to happen when you do that is the stock price is going to go up, because now the supply and demand mean that there's less demand, so the price is going up, and also the EPS is going to go up. But overall, using debt in order to do that is quite risky. Also, one reason is that now that you use debt, your borrowing power has been used to buy back some of your shares. You can't use it anymore to expand your business or reinvest into R&D. You already used that, that borrowing room and borrowing power to buy back some of the shares. So it could have some and add some risk and instability into the firm if they start doing this. So there's two other options to the traditional IPO that I'm going to touch base with you. The first one is direct listing, which is very simple. It just means that they bypass the underwriter stage. Basically, the issuer is just doing everything themselves. So it's typically more risky, okay? But it's something that you can do, and there potentially is some financial benefit to do that as long as everything goes well. And another one that's pretty famous is the Dutch auction. And that's actually a way that Google went when they went public. And basically, with the Dutch auction, the IPO price is not set. Okay, a Dutch auction is a public offering auction structure in which the price of the offering is set after taking in all the bids. So in this type of auction, basically investors place bids for the amount they are willing to buy in terms of the quantity and price. And once all the bids have been submitted, the allotted placements are assigned to the bidders, okay, from the higher bid down to the lowest bid until all the allotted shares are assigned. And the price that everyone is paying for those bids is basically based on the lowest price of all the allotted bidders. So essentially the last successful bid that is taken, this one is the one that's defining the stock price. So let's say you bid $100 for per share, but the last bid actually paid $80. Well, $80 is the price that everyone is going to pay for those shares, assuming that the price is above the reserve price. And the reserve price prevents, a bidder who offers a price lower than what the owners will accept from winning the auction. Otherwise, if in the end the stock price ends up being like $1, and in that case Google had been like, no way we would go that low, they would just set up a reserve price to make sure that at least they get at least the minimum that they are willing to sell it for. And now, like I mentioned a bit earlier, there's the options to do a secondary offering. And so now we're going to talk about non-dilutive secondary offering and dilutive secondary offering. So first we'll start with non-dilutive secondary offering. And so a non-dilutive secondary offering, basically it doesn't affect or dilute the shares of existing shareholders, just because there's no new shares that are being created into the outstanding share pool. And so the issuing company might not actually benefit at all, simply because those shares are actually being offered for sale by private shareholders. And so typically those shareholders are typically, company founders, the board of directors, pre-IPO investors. And so since no new shares are being issued, the company's EPS remain the same. And this type of secondary offering is quite common in few years after the IPO, once the lockup period is done. And that gives an option for, original investors into the business to actually cash out at that time. And a dilutive secondary offering, which is also known as a follow-on offering, is when a company itself is creating and placing new shares onto the market, which is also going to lead to diluting the current existing shares. And this happens when the board of directors agrees to increase the share float for the purpose of selling more shares, selling more equity, which could be, a reason if they need more cash, an influx in cash, they might do that, release more shares. So now, people can buy more of those shares. But one thing that's going to happen with that type of scenario is that now the number of outstanding shares is increasing, which will lead to dilution, as we said. And so the EPS is going to come down. And so typically, this influx in cash, because they release more shares, the shares got sold, that has an influx in cash, that can be beneficial for the business. They could maybe potentially buy back some of the debt or subvention the expansion of the business. And typically a dilutive secondary offering usually results in some sort of price per share going down, okay? And that some investors don't see this with a good eye, especially if they have a short-term vision, or maybe they did not expect to be holding that stock for that long. The price is coming down, they don't like that. But typically, if done correctly, this secondary offering can actually help the business grow and help them expand and have a better outcome in the future. Now, I want to very quickly touch base on the option to invest in IPOs. Investing in an IPO is typically riskier, okay? Because it's the first time that this company will ever be traded. You don't have any historical data. You don't have the financials because they don't have to release them into the wild yet. Also, typically the companies that are doing an IPO are pretty early stage, so they are not as well established. So that's also adding an extra risk there. Studies have shown that about 60% of the time, the share price in the next and in the following 12 months is actually coming down from the IPO price. So for us investors, unless you really like to take risks, with your money, and you don't mind that type of risk, maybe could be viable, but for most people out there, I would advise you to wait, like when there's an IPO, wait a few years until the company went public, because then you will have, more data, they will have a track record, you'll have all the financial information over the years, you'll have that. You will avoid a lot of those risks. Let's say, like I just mentioned, the stock price going down 60% of the time the 12 first months. And for investors who like and would like to have a foot in the IPO world, there's some funds, so mutual funds or like index or ETF, that are actually focusing on the IPO universe. So you are able to invest into those funds, and then you will get exposure to several companies that are having an IPO. For example, there's one that's the First Trust US Equity Opportunities ETF. So the acronym is FPX. So you can look into that if you are interested into having a foot into the IPO while still having, you know, some diversification and not having all your eggs into that one IPO. So that's it for the IPO subject today. I hope it was helpful for you guys. I hope you learned something today regarding the IPO world. I think it's a fascinating subject that's not being talked about that often, but it is a very important and integral piece into almost every businesses out there, if not now, maybe a few years down the line. So yeah, I think it's quite important for everyone out there to understand, at least be familiar with those concepts. So I hope it was helpful and you learned one thing or two. If you did, please subscribe, really helps. And yeah, I'll see you in the next video. Cheers, thank you.